Imagine this. Over 80% of investors miss out on the best performing stocks because they don't know how to spot them early. That's right. According to a study by J.P. Morgan, a small handful of stocks drive most of the market's returns, but many investors overlook them until it's too late. Shocking, right? Here's another mind-blowing fact. Some of the biggest stock market winners started as underdogs, flying under the radar while the crowd chased the latest hot trend. Amazon, for instance, was once dismissed as just a bookstore. Now, it's one of the most valuable companies in the world, having increased its stock price by over 100,000% since its IPO. What if you could find the next Amazon before it explodes? That's what this video is all about, teaching you how to spot undervalued stocks before they boom. We're diving into 6 strategies that can help you uncover hidden gems, outsmart the market, and potentially secure massive returns. We'll explore everything from reading between the lines of insider moves to profiting from market misdirection. Whether you're new to investing or a seasoned pro, these tips could be game changers for your portfolio. Ready to discover the secrets that most investors miss? Let's dive in. Chapter 1. Hidden Gems. Uncovering stocks the market overlooks in the world of investing. The real treasures often lie hidden in plain sight. These are the stocks that don't make headlines but have the potential to deliver impressive returns. Finding these hidden gems requires a keen eye and a bit of digging, but the rewards can be worth the effort. Start by looking at smaller companies with a market capitalization under $2 billion. They might not have the buzz of big-name stocks, but they can offer substantial growth. A Bank of America study shows that small-cap stocks have outperformed large caps by an average of 2% annually over the past 90 years. Explore niche industries like renewable energy or specialized tech. Sectors not widely covered by the media often contain hidden gems. For example, renewable energy stocks have surged over 45% in the past decade, yet many companies in this sector remain undervalued. Check out stocks with low price-to-book (P/B) ratios combined with high insider ownership. A low P/B ratio suggests undervaluation, and high insider ownership indicates confidence from the executives. According to MSCI, companies with high insider ownership generally outperform those without. Look for companies with strong fundamentals but little analyst coverage. Stocks with fewer than 5 analysts covering them often outperform the broader market, as found by Harvard Business Review. These under-the-radar stocks can offer significant upside potential. Don't underestimate the power of online investment communities. Forums like Reddit's R-Value Investing can be goldmines for discovering lesser-known stocks. Just remember to do your own research before acting on any tips. As the saying goes, the best investment you can make is in yourself. Chapter 2. The Underdog Advantage. Betting on industry misfits. Underdogs have a special place in the world of investing. These are the industries or sectors that are currently out of favor but have potential for a comeback. Spotting these undervalued areas requires a bit of contrarian thinking. Consider industries in decline but still essential. For instance, the coal industry has been struggling due to environmental concerns. Yet, certain coal stocks saw a resurgence, with the Dow Jones U.S. Coal Index gaining nearly 40% in 2022. Identifying such industries can uncover valuable investment opportunities. Focus on cyclical industries that rise and fall with the economy. Sectors like automotive or construction can be undervalued during downturns. McKinsey reports that investing in cyclical stocks during a downturn can lead to returns of 15–20% when the cycle turns positive. Look for companies that are out of favor due to temporary problems but have long-term potential. For example, Ford's stock was battered during the 2008 financial crisis but rebounded by over 300% in the following years for those who bought in at the low point. Monitor industries facing temporary setbacks. Oil stocks, for example, often face price volatility due to geopolitical events. According to J.P. Morgan, energy stocks have delivered an average annual return of 12% over the past 30 years, despite short-term setbacks. Diversify within these misfit industries. Spread your investments across several companies to reduce risk and increase your chances of finding a winner. As Peter Lynch noted, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. Loving the content? Subscribe and let's jump right back into the action. Chapter 3. Numbers don't lie. Mastering the art of financial sleuthing. When it comes to value investing, numbers are your best friend. But it's not just about knowing the basics like P/E ratios. The real magic happens when you dig deeper and uncover insights hidden in plain sight. Start by examining the company's balance sheet, focusing on the debt-to-equity ratio. A high ratio can indicate potential trouble, while a ratio below 1.0 often signals stability. Moody's report shows that companies with lower debt-to-equity ratios tend to be more stable and successful. Analyze free cash flow, FCF, to gauge financial health. Strong FCF indicates flexibility for growth, dividends, or debt reduction. Howard Marks in The Most Important Thing says, companies that generate a lot of cash can weather downturns better and take advantage of opportunities. Look at return on equity, ROE. High ROE signals effective use of shareholders' equity to generate profits. Companies with a consistent ROE above 15% often outperform the market, as noted by Harvard Business School. Examine the price-to-sales, P/S, ratio, especially for companies with no earnings. A low P/S ratio can indicate undervaluation relative to revenue. Peter Lynch suggests that it's hard to go bankrupt if you've got no debt and your sales are still growing. Monitor gross margins. High and stable margins indicate strong pricing power and efficiency. Companies with margins above 40% often have a competitive advantage, according to McKinsey & Company. Check the inventory turnover ratio. A high ratio suggests efficient operations and strong demand. Benjamin Graham in The Intelligent Investor said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." Chapter 4. Insider Insight. Reading between the lines of executive moves when spotting undervalued stocks, insider activity can be a goldmine. Executives and board members have a unique perspective on their companies. Understanding their actions can provide valuable clues about a stock's true value. Start by tracking insider buying. When executives purchase shares, it's often a strong signal they believe in the company's future. University of Michigan research found that stocks with significant insider buying outperform the market by an average of 4.5% annually. Watch for clusters of insider buying. When multiple executives buy shares simultaneously, it can be a stronger indicator of value. According to the Journal of Finance, cluster buying is more predictive of future stock performance than individual purchases. Consider the timing of insider purchases. If insiders buy after a significant stock price drop, they may see an opportunity. Warren Buffett advises, be fearful when others are greedy, and greedy when others are fearful. Look at insider ownership. High insider ownership aligns executives' interests with shareholders. Companies with insider ownership of 20% or more tend to outperform others, as reported by Morningstar. Monitor stock options and grants. Executives exercising options and holding onto shares can signal confidence. Peter Lynch observed, insiders might sell their shares for many reasons, but they buy them for only one. They think the price will rise. Be cautious of insider selling. While not always a red flag, large or frequent sales could indicate overvaluation. Analyze the context of sales to determine if they signal trouble or are for personal reasons. Chapter 5. Market Sentiment Misdirection. Profiting from crowd psychology. Market sentiment can lead investors astray, driven by emotion and rumors rather than fundamentals. But understanding and capitalizing on this sentiment can uncover undervalued stocks before they rebound. Adopt a contrarian approach. If market sentiment is overwhelmingly negative, it might be the perfect time to buy. Warren Buffett's advice rings true. Be fearful when others are greedy and greedy when others are fearful. Use the VIX, or Fear Index, to gauge market sentiment. High VIX levels often indicate fear, which can present buying opportunities. JP Morgan's research shows that high VIX periods can lead to significant stock price gains when the market stabilizes. Social media platforms like Twitter and Reddit offer real-time sentiment insights. However, beware of the amplified noise. Benjamin Graham cautions, the investor's chief problem, and even his worst enemy, is likely to be himself. Review investor surveys like the AAI's weekly sentiment survey. When a majority of investors are bearish, the market often performs well in the following months. Historical data supports this as a strong indicator of future stock performance. Look for stocks with strong fundamentals that have been beaten down by negative sentiment. CFA Institute's research indicates these stocks can outperform the market by 6–8% annually once the market corrects itself. Monitor analyst ratings. Downgrades can cause short-term price drops, presenting buying opportunities if based on temporary issues. Peter Lynch advises, there's always something to worry about. Avoiding stocks because of these worries almost always proves costly. Chapter 6. Catalyst Countdown. Timing your entry before the boom. Timing is crucial in investing, especially when waiting for a stock to hit a catalyst. Recognizing these events before they occur can help you buy undervalued stocks at just the right moment. Earnings reports can be powerful catalysts. Strong reports often lead to stock price surges. Zacks Investment Research notes that stocks with positive earnings surprises typically increase by 2–3% in the following week. Product launches can drive excitement and stock price increases. For example, Apple's new iPhone launches often lead to stock price surges. Harvard Business Review found that stocks with major product launches outperform the market by 5% over 6 months. Mergers and acquisitions, M&A, often lead to price jumps. Identifying potential M&A targets before the deals are announced can be profitable. Deloitte reports that M&A stocks see a 20% premium on their price. Regulatory approvals, especially in biotech, can be major catalysts. FDA approvals can lead to significant stock price increases. Biotechnology Innovation Organization's research shows stocks in this sector can gain up to 30% following approvals. Management changes can signal shifts that boost stock prices. When new CEOs or executives come aboard, they often lead to significant stock gains. Satya Nadella's leadership at Microsoft saw the stock price nearly triple in 5 years. Economic indicators like interest rate changes can also act as catalysts. Lower interest rates often boost sectors like real estate. Federal Reserve data shows a 1% drop in rates can lead to a 10–12% increase in stock prices in sensitive sectors. Finally, track industry trends. Emerging industries often outperform the market. McKinsey & Company reports that stocks in growing sectors can exceed broader market returns by 15–20% over 5 years. By combining these strategies, you can uncover undervalued stocks and position yourself for significant returns. It's about looking beyond the obvious and timing your investments with precision. Happy investing! Your support means the world to us. Subscribe now to keep the content coming.